Hello and welcome to another video on US taxation. So today we are here to present on rental income. In the previous chapter, we discussed self-employment income, which represents earning generated by the individual who operate their own businesses or provide services independently. Uh, we learned how self-employment individual determine their business income, deduct the business expense, calculate the net profit, and then compute the self-employment tax. And then finally file their reported information in the form of Schedule C, which is being then reported via Form 1040. Here we are going to talk about one of the most important attribute of income, which is the rental income, which arises when property owner allow tenants to use their property in exchange of the periodic payments. So rental income can be generated from a variety of the properties, including residential houses and the apartments, commercial building and the office spaces, vacation rentals, land leased for agriculture or the commercial use. So unlike business income, rental income is generated and normally classified as a passive income. So with this, let's start the discussion and proceed towards the first slide, which is the agenda slide, which clearly lay down what all things that we are going to learn in this chapter. So let's move to the agenda slide. So key agenda that we're going to cover as a part of today's discussion is we'll touch base upon the introduction of the rental income, which clearly speaks about the various attributes of rental income. We'll talk about the properties that generate the rental income, and then we'll also look at the constituents of the rental income. We'll understand the expenses which are deductible from the rental income to derive at the final net rental income. Understand the concept of depreciation on the rental property and how we have to calculate the net rental income. We'll also understand the concept of Schedule E, which is the format which on which the rental income and the losses needs to be reported, which is finally being used for filling the form 1040. And then we'll understand the passive activity rules for the rental income. We'll also demonstrate the entire understanding of the rental income through a detailed example, and then we'll talk about the final synopsis of this chapter. So with this, let's move to the first slide and understand the concept of rental. Okay. So when we talk about the rental income refers to the payment received by the property owners for allowing another person or business to use their property. So this income arises when the real estate such as the residential houses, apartments, commercial buildings or land is leased or rented to the tenants. Specific to the US tax system, rental income is generally treated as a taxable income, and it needs to be reported by the relevant taxpayer in their return via form Schedule E, and then this needs to be finally reported into the form 1040. So having understood the concept of rental income, basically we know that this is something which is being generated by the property which has been kind of created by the individual, and then that property is yielding a income in the form of the rent. So we'll understand the type of the sources of the rental income here. So residential property is one property which generate the rental income. Commercial property is another set of the property that generate the rental income. Then vacation of the short-term rentals, and then land lease for agriculture or the business use. See, the owner of the property, often referred to as the landlord, and receives the rental payment to for the tenants in exchange of the property which has been leased out or rented. So common form of rental payments are regular monthly payment, advance rent, a security deposit, lease cancellation, expenses paid by the tenant on behalf of the tenant. And we are going to touch base upon all these attributes of the rental in the upcoming slides, and we'll have a detailed discussion that how these are treated while computing the final net rental income. Tax treatment of rental income is that rental income is generally treated as a passive income, which means that taxpayer earns income from the property ownership rather than the active services. A landowner is can claim the deductions, some of the expenses that he normally done to maintain the property, which includes the maintenance and repairing cost, property tax rate, mortgage interest, insurance premium, and property management fees, which are typical some of the deductions which are allowed to be deducted from the gross rental income to arrive at the net rental income. And this is being reported via Schedule E, which is then finally reported into Form 1040. Reporting rental income is that rental income is reported using the Schedule E, which allows the taxpayer to list the tax total rental income received, deductible expenses related to the property, depreciation of the rental property, and then the net income or the loss calculated on the Schedule E is then reported on Form 1040. With this, we'll move to the next slide. Okay, now we'll spend some time in understanding the type of the rental property, because this is very important element, that what kind of properties do generate the rental income. So rental properties refer to the real estate assets that generate the income by being leased or rented to the tenants. Property owners earn rental income by way of allowing the individual's business to use the property in exchange of the periodic payment. So residential rental properties, residential rental property are real estate units which being let out to the individual family for living purposes, like single family homes, apartments, condominiums, and duplex. Uh, in these property, tenants typically sign lease agreement and paid the rent on the monthly basis, and these are normally a large term agreement, which is like a couple of years or year. Rental income from the individual families, and they commonly owned by the individual land. Then we have another category, commercial rental properties, which is like commercial property are building for spaces rented for the business or the commercial activities. Example, office building, retail stores, restaurants, etc. Uh, Key characteristics: rental agreements within the business, higher rental income potential, and the longer lease duration. We'll move to the next slide and look at rest of the category of rental property. Okay. Third category is vacation or the short-term rental properties. These properties are rented for the short duration, often for the tourism or temporary stay. Example, vacation home, beach houses, short-term rental listed for the travel platforms. Key characteristics are short-term rental, higher rental rates per night. Income may fluctuate depending upon the seasonal demand. And then we have mixed-use property, which can claim for both the residential and the commercial component within the same building, which includes the building with the retail shops on the ground floor and the apartment above. Key characteristics: combination of the residential and the business tenant, rental income from the multiple sources, and different expenses allowed as per the rules of each of the type of the property. And then we have the land rentals or the lease income. Land can also be rented as a leased or the various purposes. Example, agricultural land leased to the farmers, land leased to the parking facilities, land leased to the commercial development, and the key characteristics are income generated from leasing rather than the building. And the often involves the long-term leasing. So these are like five category of the property that will generate the rental income for the individual. Residential property in the form of housing departments and condominiums, commercial property in the form of office, retail stores, and the warehouses, a vacation rental like short-term rental homes, tourist accommodation, and then mixed user property, which is being building which is used for both the commercial and the residential purposes, and then the land rentals like agricultural land or the lease land, which is being leased out to the businesses for a commercial purposes. So with this, we'll move to the next slide and look at the other information for the rental income. Okay, now we'll talk about the constituents of the rental. So which means that we'll talk about various attributes or various constituents that comprise the total rental income. First one is the regular rental payment, which means like a payment which is being made by the tenant to the landlord, which can be monthly, quarterly, annually, depending upon the rent agreement. Second is the advance rent. So advance rent refer to rent received before the period it covers. Even if the payment applies to the future rental, it must be reported as income in the year in which it received. So basically, it is the concept of the receipt basis. So rental needs to be reported on the receipt basis for the year in which it has been received rather than the year in which it has been accrued. Next is security deposit when retained. So security deposits are normally not considered rental income when received, provided they are not intended to they are intended to be retained. But if they are intended to be retained, then definitely it has to be included as a part of the rental income. However, if the landlord is part of all the deposit to damage or rent, the retained amount becomes the taxable and the rental income needs to be reported. For example, a security deposit received for $1,200, retained amount is 400, then taxable rental income will become $400. So we'll move to the next slide and see rest of the constituents of the rental income. Next element is the lease cancellation payment. So if a tenant pays the landlord to terminate a lease agreement early, the payment is considered as a rental income. And likewise, sometimes tenant pay expenses on behalf of the landlord, such as property maintenance or the utilities. If these expenses are the landlord's responsibility but are paid by the tenant, the payment is considered as a rental. Tenant pays 300 for repairs, that is being landlord responsibility. This amount is treated as the rental. And then finally, the payment of additional services. If the landlord provides additional services related to the property, payment receipt for those services may also be treated as rental. For example, if the landlord provides the parking fees parking, and then he collects the parking fees. The landlord collects the laundry facility services, maintenance services. These amount must be included as a part of the rental income and will be charged by as a rental in the hand of the assessee. So regular rent is the taxable rental income, advance rent taxable in the year received, retained security deposit taxable rental income, lease cancellation payment taxable rental income, tenant paid expenses considered rental income, and additional service payment included in the rental. Okay. Now, having understood the concept of the rented properties and then the property that generate the rental income, and then we have also understood the concept of the rental income and then the various constituents of the rental income. So now we have to understand the expenses that are deductible from the rental income. So expenses that qualifies from the deduction from the rental income are the mortgage interest. So interest paid on the loans used to purchase or improve the rental property is generally deductible, which includes the interest on the mortgage loans, interest on the home equity loans used for rental property improvements. So mortgage interest often represents the one of the largest deductible expense for the property owners. Second one is the property taxes. Property taxes paid to the local government or the rental property are fully deductible as a rental expense. These taxes are typically assessed annually based on the property valuation. Next category is repair and maintenance. Cost incurred to maintain the property in a good and operating condition are deductible. For example, fixing plumbing, electrical issues, painting, minor renovation, repairing the application of furniture, appliances and furniture, and these expenses are deductible in the year they are incurred. Next is the insurance premium. Insurance costs related to the rental property are also deductible. Example, property insurance, liability insurance, fire or disaster insurance. And then finally, the property management fee. Many landlords hire professional property managers to handle tenant related to the property maintenance, and the management fees paid to these are fully deductible from the business, from the as a business expense from the rental. So we will move to the next slide. More expenses that can claim it as reduction from the rental income are the utilities. If the landlord pay utilities for the rental property, those expenses can be deducted. Example, electricity, water, sewer charges, gas heating expenses, trash collection services. Even expenses incurred to advertise rental property attracts tenants are deductible, like online rental listing, real estate exchange commission, newspaper digital advertisement. And then the legal and professional fees. So property owner may incur professional fees related to the managing rental properties, which includes the legal fee related to the lease agreements, accounting for the tax preparation fees, consultancy fees. So typically, all expenses that are incurred and which are required to generate the rental income, or the expenses that are required to maintain the property in the proper condition, which can then help the individual to generate the rental income, are deductible from the rental income and to derive at the net rental. So expenses which are not deductible are not deductible are the certain costs that are not treated as regular expenses but are instead capitalized and depreciated over time. For example, these are the expenses which are incurred, but they are not deductible in the one go, and they are deductible in a specific percentage or over the life of the property. So like major renovation of the property improvements, construction of the new structure, significant upgrades that increase the property value. So these costs are recovered through depreciation reduction over the multiple years. For example, deductible expenses are so John has a rental property and receives 24,000 in annual rental income. During the year, he incurred the following expenses. So this is the list of the expenses which he incurred, like he incurred the mortgage interest, property taxes, repair and maintenance, insurance, property management. So all these would be deductible expenses. So if you sum up all these, that comes to somewhere around 40,500, and thus these expenses will be deducted from the rental income. The final net rental income is 9,300, which is then reported via Schedule E, and that will flow into Form 1040, on which tax will be applicable. So we'll move to the next slide. Okay, so now we'll talk about another unique concept in the rental income specific to US taxation is the depreciation of the rental property. So depreciation is a tax deduction that allows property owners to recover the cost of the rental property over its useful life. So this building gradually wear out or become obsolete over the time, the tax system allows the landlords to deduct a portion of that property value each year as a depreciation expense. So depreciation helps reduce the taxable rental income by allocating the cost of the property over the several years rather than deducting the entire cost in the year of the purchase. So rental income expense and depreciations are generally reported in the Schedule E, and resulting net income flows into Form 1040. What property can be depreciated? Not all property qualify for depreciation. To qualify the property to claim the depreciation, the property must meet the following conditions. What are those? The property must be owned by the taxpayer. This is first condition, and all the condition needs to be met. It must be used for the income producing purpose, such as the renting of the tenant. The property must have a determined useful life. The property must be expected to last more than 1 year. Example of depreciable property is residential rental building, commercial building, furniture and the appliances used in the rental units, improvement made to the rental property, and the other any relevant expenditure that has been incurred for which the benefit is going to accrue over the period of the time. Land itself cannot be depreciated because land does not wear out or lose the usefulness over the time. So depreciation is largely on the building and furniture plus any other fitments that has been done which improve the quality of the building, but the benefit can be claimed over the period of time. Useful life of the rental property, the IRS provides the standard recovery period for different type of the rental properties. For residential rental property, it is 27.5-year recovery period. For commercial property, it is 39 years. So residential rental property is depreciated over 27.5 years using the straight line method. The most common method used for the property is the straight line depreciation method, which spreads to the property used over the useful life. So annual depreciation expense is the property value divided by the recovery period. For example, property value allocated to the building is 2,75,000, depreciation is 27.5, annual depreciation is 27,500, 2,75,000 divided by 27.5, which is 10,000 per. So this is the depreciation expense that is being allowed for that particular property. Moving to the next slide. Okay. Now we'll understand how we have to determine the depreciation basis. So depreciation basis of the rental property includes the purchase price of the building, closing cost related to the acquisition, and capital improvements made to the property. However, the value of the land must be excluded from the depreciation basis because land is not subject to the depreciation. So what then we have to include? We have to include the property value plus any major enhancement which has been done to improve the life of that property. Those needs to be included to calculate the depreciation on the rented property. For example, total property purchase 3,50,000, land value is 70,000, building value is 2,80,000, depreciable basis is 2,80,000, and this is the amount which will be divided by 27.5 or 39 as the case may be, depending on the type of the property. Depreciation calculation, Sara purchased the rental property of 3 lakh, allocation land value is 60,000, building value is 240. Since land cannot be depreciated, only the building is to be depreciated, so 240 divided by 27.5, assuming it's a residential property. So 8727 per year is the depreciation allowance that will be available to Sara, which can be claimed as a deduction. This amount can be deducted each year as a depreciation expense. So impact of depreciation on rental income, depreciation reduces the taxable rental income. Annual rental income 30,000, total expense 18,727, which includes maintenance, property taxes, insurance, and then depreciation. This will be excluded, and then final rental income is $11,273, which will be reported via Schedule E. So importance of depreciation. Depreciation is one of the most significant tax benefit available to rental property because it reduces the taxable rental income, reflects the gradual wear and tear, and helps property owners to recover the investment cost over time. So we'll move to the next slide then. Okay. So having understood what constitutes the gross rent and what are the deductions, understanding the concept of depreciation, now we'll understand the concept of net rental income, which is nothing but when we deduct all the deductible expenses from the gross rental income and we deduct the depreciation expense for that particular property, we'll get the net rental income. So deductible rental expenses will be deducted from the total rental income, depreciation expenses deducted, and then we'll have the net rental income or the loss as the case may be. So total rental income includes the monthly rental payment, advance rent received, lease cancellation payment, retained security deposit, tenant paid expenses that are landlord responsibility. Deductible expenses are mortgage interest, property taxes, insurance premium, repair maintenance, property management fees, utilities paid by the landlord. These expenses are reduced the taxable rental income, and then we'll deduct the depreciation expense to calculate the final rental. So move to the next slide and see rest of the part of this slide. Depreciation expense, we already know that this is an expense which is being deductible on a yearly basis. It allows landlord to recover the cost of the property of the time. For residential it is 27.5 and for commercial it is 39. So David on residential property receives the following rental income: monthly rent 2,000, annual rental income is 24,000. Rental expenses are below: mortgage interest, property taxes, repair and maintenance, insurance. Total operating expenses sums to 11,200. Depreciation expense, building value is 2,20,000. and then we'll divide this by 27.5. We'll get 8,000 as depreciation expenses. So we'll reduce that 8,000 from the final rental income along with the deductible rental expenses, deductible deductions to get the final net rental value, which is being reported via Schedule E, which finally flows via Form 1040. So we'll move to the next slide then. Okay, now we have been talking about one important schedule basis which the income from the rental flows into Form 1040. That is the Schedule E. Now we'll talk about Schedule E and understand the basic concept of Schedule E. So, Schedule E is used by taxpayer to report the income or the losses from the rental real estate royalty partnerships as corporation estates and the trust. The most individual taxpayer who own rental property, Schedule A is used to primarily report the rental income and the rental expenses. The net income or the loss calculated in Schedule E is then transferred to Form 1040. So, what is the purpose of Schedule E then? Report the total rental income received during the year, deduct the allowable rental expenses, calculate net rental income, and then report the income from multiple rental properties. So, it has five parts. Part one is income or the loss from the rental or real estate from royalties. Part two, income or loss from the partnership and the S corporation. Part three, income from the estates and the trust. Part four, income from the real estate mortgage investment conduits. Part five is summary of the supplemental income or loss. So we'll move to the next slide and look at some of the more information for Schedule E. Part one of the Schedule E is rental real estate and royalty. Part one schedule reports the income and expenses to the rental properties. This section allows the taxpayer to report the information for the multiple properties in the same form. The key information that needs to be reported in the form Schedule E is property description, rental income, expenses, depreciation, and the net income or the loss. So common expenses reported in Schedule E are the mortgage interest, property taxes, insurance premium, repair maintenance, property management fees, utilities paid by the landlord, depreciation of the rental property. These expenses reduce the taxable income, which is finally being reported in the Form E, and then being from Form E is flow into Form 104. So rental income, then Schedule E, calculate the net rental income, transfer to Form 1040, that is included in the total taxable income. So we'll move to the next slide. Okay, now we'll talk about a very important concept for the rental income, which is the passive activity. So we know that rental income is being generated by the property that is being purchased by the any person, and then the property generates the income. So this is not an active income. This is the income which is passive income because the person is not working to generate that income. The property that he has purchased is generating the rental income, and hence it is treated as a passive income. So under US tax law, most rental activities are classified as passive activities. Passive activity rules determine how income and the losses from the rental properties are treated for the tax purposes. Particularly when taxpayer attempts to deduct the rental losses against the other type of the income. These rules were introduced to prevent the taxpayer from using the passive losses to offset the active income. So basically, there are certain rules whereby the SSC cannot deduct the passive losses or the income from the rental losses, losses from the rental to be adjusted from the active income. There are certain rules, and we'll talk about this in detail in this slide. So, what is the passive activity? Passive activity is the business or the income generating activity in which taxpayer does not materially participate. Rental and real estate expenses activity generally considered passive regardless of the level of the involvement of the property owner. So example of passive includes the rental property income, investment in the limited partnership, ownership of the income producing property managed by the others. So in these cases, taxpayer earn income without active day-to-day participation in the business operation. So passive income versus passive losses. So rental activity can generate either the passive income or the passive losses. So passive income, profit earned from the rental property. Passive loss is the expenses exceeded the rental income. For example, if let's say rental income is 20,000, but the depreciation expense is 25,000, then there's a net rental loss of 5,000. And then what are the limitation of the passive income? Passive activity rules generally restrict the ability to deduct the rental losses against the non-passive income, such as the salary income, self-employment income, or the interest or dividend income. So instead, passive losses can usually be used only to offset the passive income from the other sources. If passive losses cannot be used in the current year, they are carried forward to the future. This is a simple rule. So for example, if there are multiple properties and there are passive income from few of the properties and passive losses from other properties, those can be offset within the same financial year. But if let's say passive losses exceeds the passive income, then it cannot be set off against the active income, which includes the salary, investment income, or the self-employment income. Then what happened? Then it will be carried forward and will be adjusted in the future year whenever there is a passive income. So we'll move to the next slide. Okay, there is some special allowances for the rental losses. Tax law provide the limited exceptions to the certain taxpayer who actively participate in managing their rental property. Taxpayer may deduct up to $25,000 of rental losses against other income if they meet certain conditions. So we discussed that passive losses cannot be adjusted against the active income, but there are certain exceptions to that, which means like special allowances for the rental losses. The expenses or the passive losses up to $25,000 can be deducted by a person who participate actively for his managing his rental property, and if he meets certain conditions. So what those conditions are: active participation in managing the rental property and modified adjusted gross income below certain limits. This allowances help small landlords benefit from the limited loss reduction. So phase out of the specific allowance, special allowances, 25,000 special reduction gradually phases out as the income increases. So basically, this is being benefit which is given to certain set of individual who are earning a particular amount. But if their income, you know, uh, reaches, or let's say is more than a particular limit, then this expenses will not be allowed. So up to 1 lakh, up to 20, for 25,000 losses allowed, 1 lakh to 150 deduction gradually reduced, and above 1 lakh 50,000 no special deduction is allowed. So example, passive loss limitation is, let's say Michael owned a rental property for rental income is 18,000, rental expenses for depreciation is 28,000, the loss is 10,000. If Michael actively participated in his income is below the threshold, he may deduct 10,000 rental losses against the other income. If this income exceeds this limit, the loss may be carried forward to the future. This benefit is largely for the small taxpayer, but if they breach a particular threshold limit, then this reduction is not allowed. Importance of the passive activity rules are: passive activity all rules are important because they prevent the misuse of rental losses to reduce the unrelated income, ensure the proper classification of the passive income and losses, allow controlled reduction through special allowances, and maintain the fairness in the tax system. So we'll move to the next. Okay, so now what we have done, we have created a detailed example and we'll talk about the entire concept of rental income, covering all the attributes of the rental income and then the deductible expenses, including the depreciation. So John owns a residential property that he purchased for investment during the tax year. He rented the property. Following are the details: monthly rental is 24,000, advance rent received 2,000, security deposit retained for the damages is 500. So identify the deductible expenses. So step one is we have to calculate the total rental, and then we have to identify total deductible expenses. So which are mortgage interest, property taxes, insurance premium, repairs, property, and then the advertisement from the tenant. Total operating expenses are 16,000. Next, we'll calculate the depreciation. So John purchased the property for 320, which includes both the building and the land. Allocation is the 70,000 for the land value, building value is 250. We'll divide the 250 by 27.5 to get the total depreciation for that particular year, which is 9091. We move to the next slide and see rest of the calculation. So net rental is the total rental income is 26,500, operating expenses 16,000, depreciation is 909. So which means that net rental income is $1409. So John's net rental income is 1409, and we'll apply the passive activity rules here. Rental property generally classified as passive activity. In this, property generate passive income, so no passive loss limitation applies. The income is simply reported as a passive income because it's more than the rental income is more than the deductible expenses and the depreciation, and it is positive, and hence it is being reported as the passive income. So how it flows then: rental income expenses, reporting schedule, net rental income transferred to form 1040 included in the total taxable income. And the final reported income is $1409. Okay, now this is the final key takeaways slides which summarizes what we have learned in this chapter. So typically what we have learned is that we learned that rental income is a taxable income, and it includes the various payments in the form of the rental income. That includes the monthly rent, security premium, security charges if it is retained, monthly rental payments, advance rents. So all these are the various attributes of the rental income. We understood the concept of rental property can be of different form, which is like residential property, vacation homes, commercial property, and even land that can be leased for any purpose. Deductible rental expenses are the expenses that are largely applicable for maintaining the property in the form ownership and to ensure that the rentals being generated are can be generated over the period of time. Then we talk about the depreciation, which is a very very important concept whereby the depreciation is being deducted as part of the annual expense, which is like fixed straight line method for residential building, which is 27.5, and for commercial building is 39 years. And then we also looked at the concept of net rental income, wherein we understood that how we have to arrive at net rental income, and then finally we also understood the concept of the passive income and the passive loss, and then we also understood the concept that loss cannot be adjusted in any other income. If there is a loss from multiple property and there's a passive income from multiple property, those can be set off within the same year. But if the loss exceeds the passive income, then it will be carried forward. We also understood the concept of special allowances, whereby if the owner is actively involved in maintaining the rental property and there is some income, a lower income for that particular assessee, then he can claim the deduction subject to $25,000 for in that particular year itself. But if it phases out as the income increases, and we also understood the concept that entire information of the rental is being reported via Form E, which finally flows into the Form 1040. So with this, we come to the end of this chapter. Let's move to the final thank you slide there. So in this chapter, we explored the various attributes of the rental income, what represent rental income, concept of gross rental, net rental, depreciation, and deductible expenditure. Uh, uh, so with this, we covered the rental income. We have covered the three major heads of the income. Now we have covered the salary. We covered the self-employment generated income, and then we have covered the rental. So we are going to cover capital gain as the next chapter. We're going to come with that chapter very soon. So hope you have liked this video. Please like this video, share this video, and subscribe to the channel. And do let us know for any comments if you have any questions in the comment section. And we are going to come with the new video on capital gains very soon. Until then, thank you, goodbye, and have a nice day.